All right, guys, Apple just reported. It was funny in our EM community today. Somebody said to me they thought Apple was going to report some bad earnings and revenue because they're supposed to talk a lot about stock buybacks and dividends, but they beat on both revenue and earnings per share. They reported $1.52 versus an expectation of $1.43 per share in profit, and they reported $94.8 billion in revenue versus $92.8 billion in revenue. Guys, if you're new to the channel, we talk about earnings. We do our earnings. Subscribe now. We like to do these to discuss it, but you'll see how Mo and I use bad news on earnings to make more money, not just getting excited over news. Mo, tell me some of the other benefits, some of the other big news reports in their actual release.
Okay, so that $94.8 billion, that was actually down 3% year over year.
Okay, so keep that in mind, guys.
Yep.
Keep that in mind. It's still down 3%. Now, the other thing is, it was up 3% at one point as a stock. It was back to even. Now it's up to 1.75.
Yeah.
These things go like crazy, but the revenue was down 3% year over year.
Year over year.
Okay.
Yeah. Now the earnings per share unchanged year over year.
Unchanged.
Yeah.
Okay.
Services revenue reaches an all-time high.
Okay. What is that? What's it at?
It doesn't say. It just says services revenue reaches an all-time high. I will say, I think we're going to consistently see that over and over.
I think it's going to be
so new.
I think it's going to be the way it is across a lot of companies. And the great thing about services is high margin.
Yeah.
So like if you look right here, guys, in our software, when you pull up Apple, their gross margin is 43%. You look at a company like Microsoft, it's a software business, it's 68 to 75% or whatever, right? Big differences there. But as Apple drives their services up, their gross margin is going to be very high on those because they already have the employees there. Once they build the infrastructure and the software, it's just there. They're having monthly subscription plans coming into effect. This is big. This is how you really drive up. That's how you can convert your revenue into higher margin revenue. So even if your revenue stays the same, your margin can go up, your profit can go up. And that is awesome. In fact, I'd argue that their expenses are going to go down even more.
They should. You would think. And not that this is included in here. Maybe they'll talk about it, but they did that Apple credit card savings thing.
Yeah,
they did $1 billion in a couple of weeks that people put money into there.
Yeah.
So, I mean, it's taking off, I guess.
Now, why does Warren Buffett's been buying Apple? I believe Warren Buffett thinks that Apple's worth around 140 and he's buying anywhere below that. Here's why he loves Apple. 5-year return on invested capital, 38%. What this means is when Apple invests in their business, they get a 38% return on their money. A high return on invested capital is the sign of a very good moat. Now, the issue with Apple is what? They're ginormous.
And how are you supposed to go from $2 trillion to $4 trillion valuation?
Forget about that. How are you supposed to go from $385 billion? How are you supposed to reinvest $98 billion in free cash flow? Look at this, guys. They have $98 billion in free cash flow last year. In the last 5 years, they've averaged $81 billion. Yeah. If they could reinvest this money at 30% returns, they would.
Yeah. It's probably why it says in here, right? They're buying back $90 billion worth of shares.
Now, buying back shares, everybody thinks is awesome, but it's not always awesome.
Right.
It's only awesome when the company's value is way higher than the stock price. We want the stock to be lower. The current PE is 28.
Yeah.
The 5-year PE is 36. It could be okay if they had a lot of growth potential. And there should be a premium paid for this high return on invested capital. This is a sign of a great company. But if you're buying back expensive shares, kind of concerns me. Why are you smiling?
Because Berkshire owns about 5%, and Tim Cook and Buffett meet regularly. And I wonder if he's pushing them to buy back shares or saying don't buy back shares, or if maybe they don't even talk about it.
Yeah, that's a very good question, Mo, because
he's just so involved, and I wonder if he's the one saying
who gets involved.
Buffett.
See, I don't think he gets involved.
You don't think so?
No.
I know that Tim Cook said that he meets with him regularly.
I think
to discuss capital allocation and such. I was listening to something about Tim Cook, and he said I didn't understand capital. I did not think I was a good capital allocator. That's why I pulled Buffett to come in here with me and kind of teach me that.
Well, it's funny. I can't believe he said that because it's a very admirable thing to say. Because the sign of a good CEO is somebody who's a good capital allocator. Everybody else thinks it's a salesman. It's it's somebody who can allocate the capital within the business at better returns.
He said that was my weakness, so I pulled in the guy.
If they don't have areas of reinvestment or acquisitions, you return money to investors through dividends. And if the stock is cheap, you buy back shares. In fact, you've heard us on this channel say before, I wish they would stop this dividend and just buy back shares or pay down their debt. A company like AT&T, they had an 8% dividend at one point. Mo and I were saying, cut the dividend to zero, pay down your debt, buy back your shares. That's what's burying you as a company.
Right.
And they were selling for like 8 times earnings at that time.
Right.
So what's Apple doing now? 1.3%. Yeah. Okay. So let's go check out the 8 pillars on Apple. And it's our typical, and remember, if you have our software, if you're part of our community, please don't forget you can change your pillars up to 12 pillars of your own metrics. There's like something like 4 trillion different combinations or 4 quadrillion combinations. I could do the math sometime, but everything's a check mark except for our valuation metrics. The 5-year price to free cash flow is 33. The 5-year PE is 36. Okay. So I'm glad the free cash flow is lower than the earnings. Everything else is a check mark, but they bought back 16% of their shares. By the way, can we brag about something?
Sure.
Mo's basis in Apple is $17 per share.
Yeah.
17. He already has a 10-bagger on Apple.
Yeah, it's pretty good. I do like that one.
Wow.
I do like Apple.
I remember asking him the other day, I thought you were going to say it was like 50. I'm like, yeah, what's your basis on Apple? 17. I want to murder you, Mo.
Yeah, I think it's about $17.23.
Good God. So he was talking, Paul, this is a really high price. Should I sell it? And I said to him, you're going to pay the tax. So we have this argument in the past with people. If a stock is overpriced, you don't want it anymore, and you factored in the tax, then just pay the freaking tax. Yeah. Stop worrying about it. However, you should consider the tax when you sell about what can you buy with it. And if Mo sold it, he'd probably pay $50 per share in tax. Yep. So if he sells it today for $168, he's getting basically $118. And at $118, I'd be a buyer of Apple.
For sure.
So it's kind of like, if it goes to $118, he's in the same boat. Now, of course, somebody would argue, well, it's actually the same thing. So I look at it going, Mo's decided to keep his shares. Yeah. And he's selling covered calls on them. Yep. Okay, so that's the 8 pillars. Let's see what analysts are saying. Okay, growing earnings per share, not by much. They're expected to do $8.31 per share in 4 years. Now remember, guys, these are analysts. They have a lot of biases, including career bias. They have to make sure they're along the same lines as everybody else, but it's just a nice way to just take a look at it. Now, revenue is growing mid to high single digits a year. Not bad. And as the world becomes more and more economically developed, Apple, I think, will dominate that market, just like Microsoft will, just like Amazon, just like Google. These companies will do better and better as the world becomes more and more economically strong.
Yeah, for sure.
Right?
Yeah, think about where there are not even any computers, iPhones, iPads, watches, whatever. And
where the income levels. Yeah. I mean, look at China, India, and Africa. What are the income levels there?
Yeah.
A lot lower than the U.S. Yep. A lot lower than the U.S. So we still have a lot of potential in foreign countries to be able to grow Apple. And so from a long-term perspective, that's where we're at. Now, I guess that goes to the next question. What do you pay for Apple? And this is why we always go to the stock analyzer tool, which is the most popular part of our software. Used 1.3 million times in last year in 2022 by our users. And if you like the software so far, guys, there is a special offer right now. $7, 7 days. Go to everythingmoney.com and /store if you want. But everythingmoney.com should take you there automatically if you've never been to our site. $7 for 7 days allows you to sign up. You get all the software. This thing alone is worth how much money per month? Yeah. And you get all of this plus all of our tools over here, plus all the tools that are coming, plus everything in the community. Thousands of people you can talk to about investing. You can go in there and just type in Apple and see who's talking about what.
Mm-hmm. Before we do Stock Analyzer, they also announced that they're raising their dividend 4%.
Wait a second.
Apple
not to 4%.
No. They are raising it 4% from current levels, which
isn't it like 1%? Right? Yeah,
it's like 0.5. So
So they're raising it to 0.52.
There you go.
Sick prank.
That's it. We talked about
$90 billion buyback.
That's going to probably sucker people in the 4% increase. I
just giggle at that. Okay, Mo's going to do a 10-year analysis. I'm going to do a 20-year analysis on Apple.
Okay.
Because I like to look at companies from a very long-term perspective. And 10 years is a long time, but I want to kind of look at it even further than that. So revenue growth numbers. Okay. On my low, middle, and high. Man, by the way, do you see this, Mo? Increasing ROIC.
Yeah.
Wow.
Yep.
Okay, that's a great sign. So I'm going to go, okay, profit margin. So when I do these numbers, guys, I try to go with a number on the low side that's lower than what's currently going. Sometimes, because I want to sit there for profit margin and say, let's say things have just been really good lately. Let's just say they take a little bit of a hit. And then on the high side, I try to do a little bit better than that. Sometimes. Okay. And then, so for my revenue growth numbers, before we get to Mo, I did 3, 5, and 7% revenue growth over the next 20 years. 7% revenue growth over the next 20 years would 4x their revenue. Their revenue go from 385, basically to $1.5 trillion a year in revenue. 20 years. That's a long time. Like 20 years ago, I was in college. Yeah. And the revenue numbers I'm seeing today, I would have never fathomed to have back then. Of course. What'd you do for revenue growth?
I did 3, 7, and 11.
Oh, okay. Good.
Reason I went so 11 seems high.
Subscriptions.
Right? Subscriptions. And
world development, all that stuff.
Exactly. And maybe this credit card thing.
And maybe they crush it.
Yeah, maybe they just absolutely just.
And I like the idea of doing a really high crushing number. And for 2 reasons. 1, it could happen.
Right.
But 2, if every number below is red, it shows you how overpriced the company really is, that you made really high assumptions here. So it's a good way to give yourself like, holy cow, I just made all these assumptions.
Right.
All right, profit margin. What'd you do, Mo?
I did 21, 24, and 27.
So I did 20, 22, and 24.
Okay.
But you know what? They're going to have a lot of service. No, I'm going to change this. I'm going to do 20, 23, and 26, because I forgot about that. And here's why. Like we talked about, service revenue, if they really grow that with higher margin, it should drive that profit margin up. Yeah. I can actually make the argument, nope, I'm going to go even further than that. I'm going to go even further than that. I'm actually going to do even further than that. Isn't that incredible? I'm going to do 20, 24, and 28. Guys, here's what I'm doing here. I'm sitting there saying, yeah, subscriptions will be a very high margin business. They could, if they end up being like this isn't even, Microsoft makes higher than this.
Yeah, it'll be their highest margin by far.
By far, but I'm okay with putting that in there.
Yeah.
Because remember, I'm not focusing, I'm just looking at the overall picture. Free cash flow, what'd you do?
I actually did 25.5 across the board.
Oh, wow.
I just left it there.
Well, but if they have higher profit margin, you got to bump that up. I did 22, 26, and 30.
I don't know how high to go though. Because if
I were you, I'd do 23, 25, 27.
Okay. All right, we'll change it to that.
Okay.
All right.
And guys, get a feel for this. This is investing. We don't know the future. We have to make assumptions about the future.
Yeah.
And that's why in every video when we do Apple, we have a different number for them. But the point is, we don't get $50 one time and $300 another time. You're sitting there, maybe you do 110, maybe you do any company, maybe you're within 10 or 15%. But Warren Buffett and Charlie Munger always talk about how they come up with different numbers for Berkshire all the time from each other and at varying times. PE
and price to free cash flow, I did 15, 17, and 19.
I did 16, 18, and 20 for Buff.
Wow, 20.
Listen, look at Coke.
They're remote.
Buffett started buying Coke at 29 PE back in 1987.
Right.
And I look at it going, I don't think Apple's the same as Coke from a moat perspective, but 20, okay, fine.
Yeah.
And what desired returns you do?
I did 10, 12, and 14.
So I did 10, 11 and a half, and 13, and here's why. We did 10 because we beat up the company already. So we don't need to beat it up with a higher margin of safety. We already did that in our analysis here. Remember that. We already did it up here. So we don't need to do it again. So I'm okay if I was able to buy the company at a price that was green here with a 10% return. I'd be great with that. All right, so hit the analyze button. My numbers, ready? 75 to 80, 125 to 135, 100 to 105. So this is what I mean, guys. I did a 20-year analysis with really high revenue growth numbers, and it's still red. I just feel like the company is very overpriced right now. Mo, what'd you get?
I have 75 to 83 on the low end, 152 on the high end. Call it 110 in the middle. It's on my watch list at 140.
It's on my watch list at 125. So guys, that's where we stand with Apple. Again, if you like the software, if you want to use all the other tools and have the community, everythingmoney.com, check it out, sign up, $7 for 7 days. Are you serious about money or not? That's it. If you're serious about investing, you go do it. $1 a day. Take care.